right, so I think you can see why we wanted to add a keynote speaker to our list and why we chose Brett. Just did an absolutely incredible job, incredibly insightful, and we thank him very much for that. Like he said, I'm sure many of you will have a lot of questions for him. He'll be at our booth for sure for an hour or so after this at the start of the Expo, so please stop by and ask him some questions as well as the rest of the presenters. So I am the accordion of the speaker slate. I get to try to take up or let out any slack we have in time. We're trying to get everybody to the Expo when it starts here in just a few minutes, but I do want to run through just a few slides real quickly if I could, because I think there's some important data in the fresh market that United has assessed. John Deere talked about, Dan talked about how the data-driven world we're in, and certainly United is a data-driven organization. So we think there's some important things and some insights, so I do want to take a look at that real quickly before we head over to the Expo and just point a few things out. We also always take a look at this meeting about what we expect next year and the future for potato acreage and those kind of things. So we'll talk about just a couple of those topics. So those of you that have come to this over the years know that we kind of talk about the three major areas of potato production: the yellow, the red, and the russet arenas. This is a look at the last 10-year history of yellow production. And you can remember me talking about this upward trend slope, certainly, that we see in the yellow potato world. And that has actually stabilized towards the top of this right now. Now, you saw that happen a few years ago, where we saw a little bit of a plateau there in the 2014-15 area. And so the question becomes, I've asked it before of this group, as we look at yellow potato production, where and when do we get to the top step on that ladder? Should we be exercising caution as we approach that? The returns in the yellow world have been very good, very positive, and so, but there is that challenge as this continues to expand. Now, this year we did see flattening at the top. 1 year does certainly not make a trend, but it is something we need to keep an eye on. We won't know for a few years, actually, whether or not that was the inflection point that we've talked about before. But we're looking at just under 10 million. I think last year at this event I told you yellows would probably top 10 million for the first time. They didn't quite reach that last year, 9.85 million. We expect the shipments for yellows again this year to be almost identical to that. Let's look though at the trend for this year so far, the first 5 months of yellow shipments. You can see that we're about 12% behind the pace that we were last year, and even 4% below the 3-year average was just pretty incredible given what's been happening in the yellow segment of the industry. So being that 12% behind, you flip back to this and you say, well, you're saying we're going to be flat. We're 12% behind after 5 months. And that is true. Some of the expectations for later in this marketing year, some of the areas that we expect to be up in yellow production and shipments, areas like Texas and Florida and California a little bit. The areas that are down right now significantly are ones that you might expect that had some challenges. Idaho's yields were probably off a little bit in yellows. The Red River Valley had some of those challenges in yellows, not nearly as much as in the red that we'll talk about in a minute, but a little bit of that as well. And Colorado is off a little bit in yellow production as well. So we do expect that to come back up a little bit towards the tail part of the year. That average 10-year annual growth rate that I mentioned, the last couple of years, it's been right at 10%. That has dipped now because of that little plateau that you saw there at the top. 8.7% per year is now the average. We talked about the 12% drop so far the first 5 months. With that slowing growth this year, however, if you use the 10 5-pound bale price as a proxy for grower return in the yellow market, it's still in that $14 to $16 range, and that's very good. It's a very fair price, very positive, and that continues in the yellow market, which kind of tells us we're probably not at that plateau. It's probably more of a production, more of a supply-based issue than any change in consumer trends or the environment in the yellow retail market. I've talked about before that no single region dominates the yellow market. It's kind of spread out among a number of different geographic regions. The top three there you see Idaho, the San Luis Valley, and Kern County in California. But again, are we nearing that plateau as we've discussed in that market? It's something for us to continue to consider and keep our eye on. Let's shift gears to red potatoes. The trend here that you'll see in a second when I talk about that 10-year average growth rate is virtually flat. It's actually ever so slightly negative, but as you might expect this year, it's certainly no surprise, to see that drop right here from last year. Now, let me go back 2 years. That 15.1 million there, that was a big yield year in the Red River Valley. That number would have otherwise probably been a little lower. Last year, it was more in the sweet spot of the supply-demand balance, and that 13.8 was a very good number and gave good returns. With the situation that happened this year with Mother Nature, you certainly would expect that. Actually, probably the surprise in this drop right here is that it's not, some of you may be saying, shouldn't it be even bigger than that? The Red River Valley alone is probably going to be down 1.1 million hundredweight in red shipments this year. So why isn't that down even a little bit more? I'll talk about that here just in a second. But first I wanted to look at our tracker through the first 5 months of this year. Again, it's trending almost or over 20% behind both last year and the 3-year average, again, as you would kind of expect. But then you say, well, that 1.1 million you're saying there, that's only about 8% down for the year. And it's kind of the same dynamic so far for the first 5 months of the year. That 20% reduction is coming out of areas that have had a pretty significant drop in their production, obviously. In the Red River Valley, that number is probably over 35%, is our guess, between 35 and 40% actually. Idaho's crop also in the red arena, we believe, down about 20%. Now, on the flip side of that, some of the later shipping areas in the crop year, I mentioned in the yellow market, it's something similar, but Texas certainly going to be up in red production and shipments. We believe California, probably Florida a little bit as well. Canada, which by the way is included in those numbers as imports into the U.S., so it's total U.S. usage more than just U.S. shipments. But anyway, Canada crop imports are also going to be up in the red arena about 20%. So that's why that differential on what we've shipped to date so far is a little bit lower, a bigger spread than we would expect at the end of the year. All right, let's move into russet market. And it's a similar story here, as again, as you might expect. The trend line here is certainly in a downward sloping direction, obviously driven heavily by what we're going to talk about here just in a second about what happened this year. Last year, I think at this conference, we were projecting right around 70 million and saying there was the potential for it to drop below 70 million for the first time, and it actually did that. 69.8 million last year is what we shipped in the russet market. So this drop here this year, very significant, as you all know, and we've talked about before, certainly at our meetings and at other gatherings like this. 65.8 million is what we are projecting the shipments in the russet market will be in this current crop year. Now that's, like I said, a very significant drop. It's, I think, let's see, roughly, so about 7-8%, which is a big number in the russet world. Let's look at the chart that shows our shipment projection for the rest of the year after what we've already shipped this year. So again, those of you that have seen this before, the blue lines on the left side of the graph are actual shipment numbers that we've shipped weekly to date. The projection numbers are in the orange bars on the right side of the graph. That's what we project we will be shipping for the rest of the season. The background is the 3-year average, and the dashed blue line across the top is last year's number. You can see how significantly different we are, especially going forward, but also where we've been so far in the first 5 months from last year and the 3-year average. The other two lines on this graph are pricing, or we'll call it a grower return. So the GRI, Grower Return Index, that is what the average weighted number is for all potatoes for all regions, weighted by those regions' volume on their return. The yellow line is last year, the red line is this year. So you can see what's happening there, a significant increase in returns driven by that drop in production, certainly, or a big part of it. And we started to have, we had decent pricing coming out of the year. Of course, we had the ramp up during August, as we usually do, and the inevitable drop that we always experience during the harvest month in September. We saw that same thing happen, but then things changed pretty dramatically. Last year, you can see that also not anywhere close to the dramatic nature of this year, but that does make that inflection point around the end of harvest when the barn doors go shut and all those things. That always kind of changes that dynamic. But so on this graph, can anybody guess or tell me where October 9th lands on this date and on this chart? So right there at the bottom of that inflection point was the date of the dates, I should say. It was multiple days of the frost in Idaho. In particular, it was more than just Idaho, certainly, that experienced challenges. But that was the catalyst right here that you see. And ever since then, that rise, and it's been stable now for actually a couple months up there in that $11, $12 range on the grower return for this year. So what's the correlation in the supply price data? I've talked about this in other years, and it's always interesting to look at. The average 5-year U.S. russet supply situation, a little under 73 million hundredweight is the 5-year average. The average weighted GRI, grower return index, for that same 5 years, we'll call that $7, $6.99. This year, as we just looked at, we're projecting 65.8 million, and the return to date this year, but the chart we just looked at, it's the average of that line, $11.41. So in other years, I've asked what that correlation is, what's that supply price correlation? And what that would tell you, in that comparison to that 5-year average, is that 10% lower supply gave an increase of 63% greater return. So I always throw out the example, a grower can earn more harvesting those 90 acres at $11.41 certainly than he would with 100 acres at $7. Last year, those of you that remember such things, we had a similar situation, not nearly to this scale, but 3% lower supply at that time gave an 8% greater return. So significant changes, the tightening of the market, certainly one of the catalysts that is driving that. The last thing I want to look at, I mentioned we always look at kind of our projection, what's coming up for the next year based on what's happened this year, as well as the prices for alternative crops that growers have options to change to. You heard Stephen talk about some of the dynamics in those U.S. as well as global markets and what's going on there, but what's driving some of those things. The IGRI, that's the Idaho Grower Return Index, that moved from $6.08 last year at this time, that's an average for the October through December period, up to almost $10, $9.98. That's a 64% change increase in that GRI for that October through December period. Very significant, as you might imagine. And so, given what's going to happen in these other commodities, wheat, barley, some of the others you see there, wheat's actually down some for that time period that we look at for comparison when growers are making those planning decisions. Everything else you can say is virtually flat. Corn's actually slightly up, but anyway, so all those things and I need to thank Bruce Huffaker for working with us on the model that he provides on this, and it's really these slides courtesy of Bruce and the model that we work through with him on assessing this relative strength index versus these alternative crop pricing. So the relative strength index, as you might imagine, is the highest we've ever seen it, with that 64% increase, as well as those other commodities either being slightly down or flat. So what does that mean? It's interesting, obviously, always to speculate about these things, but bear in mind that these models are not the end-all be-all. What we tell you in this model is going to happen. Hopefully, growers can and do make decisions based on these kind of events, this kind of information and education data that we provide, certainly, to the betterment of the future, to more balancing that supply and demand equation. So you can see where the acreage was last year, 939,000 acres US-wide, and then that's juxtaposed upon the harvested yield, and that's, again, nationwide. The trend line yield for 2020 is right at that 456 level. Last year, I think we were 452 or 453, so as you all know, that trend line yield goes up, certainly in the US and Canada. And so where does that relative strength index suggest that we will land in this matrix based on these yields and the percent acreage increase that it would suggest? And I don't put the vertical line on this. I'll tell you verbally what the models will say, and it's towards this end of the chart, as you might very well imagine. It's in that 5 to 6% range that the model would suggest the acreage could be up based on the relative strength index of the very significantly increased potato market versus those other alternative crop returns and commodities. So that would give a return at trendline yield. Now, of course, last year, Mother Nature made some of the adjustments for us. Wouldn't it be a really great thing if we did some of this by design and we got that supply and demand curve in balance by design and got those positive, fair returns that we always talk about? But this would suggest, if that would happen, what the grower return index in Idaho, this is Idaho's grower return index, by the way, that's what this model projects, would tell you where that would land if in fact that happens and the yields return to normal. Now, like I said, there's a number of things that influence this and that come into play. Number one is that growers can and do make adjustments to their decisions in viewing data and information. We're doing so much more of that kind of thing in today's world. You heard a lot of presenters today talking about those things, and so with that information and data, we can make adjustments and get more closer to that balanced situation that we always look for the long term. The other big factor in this, and it shouldn't go without saying, but in the frozen world, you heard John talk about this, the incredible pace of demand and what's going on certainly globally in that arena, but also domestically. And so if there's contracted acres out there that are going to processing, that's committed stuff. It's not going to find its way to the open market and become part of a what you might call a 6% overage, for example, that drives that lower GRI potential. So all those factors come into play, so that's why these models are just what they are. They're an estimate of what may happen, but certainly, like I said, there's differences and factors that come into play that can adjust to that. So I think that's it. I'm going to